What if the secret to smarter investing isn't just about picking the right stocks, but mastering your own mind and understanding the hidden forces that move markets?
Yeah.
What if the most crucial insights you need are less about complex equations and more about applying some profound, maybe uncommon, common sense?
It's a truly profound shift in perspective, isn't it? Howard Marks, through his insights, really illuminates this. So many people assume investing is purely analytical, driven by spreadsheets and models.
Right, the numbers.
Exactly. But Marx dives deep into the human element, the psychology, and the emotions that so often dictate market extremes. It's often the soft, sort of squishy stuff that matters most.
Exactly. Today, we're embarking on a deep dive into Howard Marks' profoundly influential book, The Most Important Thing, Illuminated.
And the Illuminated part of that title is absolutely key because this isn't just a straightforward discussion of Marx' original wisdom. Think of it like joining a surrogate book group.
Okay.
One where some of the sharpest minds in investment join the conversation. Investment titans like Christopher C. Davis, Joel Greenblatt, Paul Johnson, and Seth A. Klarman chime in throughout the text with their own distinct perspectives,
Wow.
their own investment styles, annotating Marx's original thoughts. It's like having these legends whisper their insights into your ear as you read along.
So you get multiple viewpoints layered on top.
Precisely. Each brings a unique lens, from Davis's innate ability and disciplined industry focus to Greenblatt's sharp eye for irrational institutional behavior, Klarman's absolute obsession with downside protection.
Always Klarman.
Always Klarman, yes.
Yeah.
And Johnson's deep academic insights. It's truly like getting wisdom from 5 of the best investment minds simultaneously.
So our mission for you today is clear. We're going to distill Marx' core philosophy, those profound, most important things, and unearth surprising facts and practical applications that can fundamentally change how you approach investing and decision-making, especially in a world often driven by emotion.
And Marx himself sees it less as a formula, right? More like a creed.
Exactly. A creed, a set of guiding principles focused on what he calls the human side of investing. His goal isn't to give you surefire recipes for massive returns.
No magic bullets here.
No, it's to guide you to avoid the most common and damaging pitfalls. And as Paul Johnson highlights in his annotations, Marx's deepest contribution might just be his extensive and incredibly comprehensive discussion of risk.
Right, Johnson actually says it's the most complete discussion of risk he's ever seen, which is saying something.
That is saying something.
That's a crucial point, because conventional thinking often simplifies risk into mere volatility. How much a stock price bounces around.
Yeah, the standard deviation stuff.
Yeah, exactly. Which Marx strongly refutes. He sees it as a far more nuanced and, frankly, dangerous concept. But before we get to that critical distinction, we need to understand Marx's foundational idea. How you can actively think differently to achieve truly superior results.
Okay, let's unpack this with what Marx calls second-level thinking. This is absolutely fundamental to his entire philosophy.
It really is.
Marx argues that to consistently outperform the market, your thinking must be demonstrably better, more powerful, and operate at a higher, more sophisticated level than the general market consensus.
It's simply not enough to just be right about an investment. You actually have to be more right than the consensus, or right when the consensus is wrong. That's the key.
What's truly fascinating here is the critical difference between what he terms first-level and second-level thinking. First-level thinking is, well, it's superficial, right? It's simplistic.
Yeah, and generally reflects common, widely held opinions. Is what Joel Greenblatt notes he hears from individual investors all the time, people who just read headlines, follow the latest financial news, or react to gut feelings.
Like?
For example, a first-level thought would be, it's a really good company, their products are everywhere, so I should buy the stock. Simple, direct, and, well, common.
Right. Okay. And second-level thinking, that's where you don't just see the headline. You actually interrogate the widely accepted narrative.
Exactly. It's deep, nuanced, and critically, it considers how others think and how they are likely to react.
So instead of just buying because it's a good company, a second-level thinker would pause and ask, okay, everyone knows it's a good company, but what if they think it's even better than it is? What if all that widespread optimism has inflated the price far beyond its actual worth?
So the conclusion might be totally different.
Totally. So even if it's a solid business, its stock might be wildly overpriced, and that means I should actually sell, not buy. It involves understanding the consensus and then turning inward to ask, what makes me believe I can see something others are missing?
And why am I confident enough to bet against the crowd? That takes a certain kind of intellectual honesty, maybe even courage.
This raises an important question for any investor. If everyone in the market is pursuing profit, how can you consistently beat the market rather than just getting average results?
And Marx argues that superior performance comes only from correct non-consensus forecasts. This means you literally have to react and behave differently from the herd.
You have to see things they don't.
See opportunities or risks that others are either missing or sometimes actively ignoring.
And Christopher Davis provides a powerful prompt for self-reflection that ties directly into this. He suggests asking yourself not just how and why you should succeed, but critically why others might fail.
That's fascinating because it forces you to look outside your own biases, doesn't it?
It does. What does that mean in a practical sense, though? Like about short time horizons or flawed incentive systems?
Exactly. It's about spotting the systematic errors others might be making. Maybe they're forced to think short term because of quarterly reporting pressure. Maybe their bonuses encourage herd behavior. Marx really distills this wisdom down with a simple but critically important 2x2 matrix.
Ah, yes, the matrix.
Paul Johnson highlights this section as critically important for achieving superior investment performance. The matrix basically shows that conventional behavior, whether it leads to good outcomes or bad ones, will inevitably lead to average results.
Because you're just doing what everyone else is doing.
Precisely. Only unconventional behavior, combined with truly superior judgment, can possibly lead to above-average results. Essentially, you can't simply follow the crowd and expect to outperform them. You have to be different and right.
That vital distinction between first and second level thinking really sets the stage for understanding how markets truly operate. And it naturally leads you to challenge some conventional wisdom, especially about market efficiency.
Indeed. The efficient market hypothesis, or EMH, originated from the Chicago School of Economics, is incredibly influential in finance. You hear about it all the time.
The idea that prices reflect everything instantly.
Right. It theorizes that all relevant information is fully and immediately reflected in market prices. The logical conclusion of this theory is that you can't beat the market consistently.
Because millions of smart people are ensuring prices are always right.
Exactly. They assume everyone is intelligent, objective, and well-informed, constantly pushing prices to their fair value.
But Marx challenges this theory head-on. He agrees that prices reflect the consensus view, but he powerfully argues that the consensus isn't necessarily correct.
That's the crucial distinction.
He uses a striking historical example. Yahoo. Remember Yahoo?
Oh yeah, .com era.
In January 2000, during the height of the .com bubble, it sold at an astonishing $237 a share. By April 2001, just 15 months later, it was trading at $11.
Wow. Quite a drop.
Marx states, and this is a fantastic quote, anyone who argues that the market was right both times has his or her head in the clouds. It has to have been wrong on at least one of those occasions.
Can't argue with that logic. It clearly demonstrates that markets can and do exhibit extreme irrationality.
The practical implication for you, the thoughtful investor, is profound. To consistently beat the market, you must hold an idiosyncratic or non-consensus view.
You have to see something others don't, or interpret what they see in a fundamentally different way. Paul Johnson emphasizes this as a very important contribution because it bridges the gap between abstract academic theory and the gritty reality of pragmatic investing.
It makes theory practical.
Right. It's the idea that agreeing with the broad consensus is comfortable, it's safe, but it's generally not where above-average profits are found. Real profits often come from diverging from the crowd, from being right when they're wrong.
And the EMH directly influenced the rise of passive index funds, right?
Yeah.
The logic was simple. If active managers can't consistently beat the market after fees and transaction costs, why even try?
Just buy the market.
Yeah, just buy a little bit of everything through an index fund and guarantee yourself market returns cheaply. But Marx has deep reservations about the EMH, particularly its definition of risk, which he believes is fundamentally flawed.
This is where Marx provides one of his most crucial insights. The EMH and many academic models define risk simply as volatility, the fluctuation of prices, beta, standard deviation, all that. But Marx argues that investors, in the real world, are primarily worried about permanent loss of capital, not just temporary price fluctuations.
That makes intuitive sense.
He puts it plainly. I've never heard anyone say, I won't buy it because its price might show big fluctuations. People don't lose sleep over volatility. They lose sleep over losing their money for good.
So volatility is just a convenient academic measure.
He views volatility as a convenient, objective, and easily quantifiable proxy for academics, but one that is ultimately misleading for practical investors. It misses the real fear,
So if markets aren't perfectly efficient and risk isn't just volatility, where exactly is the opportunity for a savvy investor?
Marx believes no market is entirely efficient or entirely inefficient. It's always a matter of degree. An inefficient market for him is characterized by significant misvaluations and by differences in skill among its participants.
Okay.
This, he says, provides the raw material for some investors to profit handsomely. As Marx succinctly puts it, inefficiency is a necessary condition for superior investing. Without it, there's no edge to exploit.
So you actually want some inefficiency.
If you aim to beat the market, yes. He encourages you, the investor, to approach markets with what he calls a rebuttable presumption of efficiency. In other words, assume efficiency as your starting point, unless there's a strong, compelling reason to believe otherwise. This prompts crucial questions. Have mispricings truly been driven out of this market? Am I overlooking hidden risks that others are ignoring?
Or the flip side.
Or, on the flip side, am I missing something where the market will offer me an excessive return because everyone else is just too pessimistic?
You know, that reminds me of that classic, slightly cynical finance professor anecdote.
The $10 bill.
Exactly. A student points to a $10 bill lying on the sidewalk, and the professor just shakes his head, saying, "That can't be real. If it were, someone would have picked it up already."
Chuckles. It's a good one.
Yeah.
It really nails the point, doesn't it? Blind adherence to efficiency can make you miss opportunities right in front of you.
And Joel Greenblatt, in his annotations, adds that some markets, like small-cap stocks or companies undergoing extraordinary corporate events like spin-offs or bankruptcies, can be more inefficient.
Right, precisely because they're less scrutinized by the big institutional players. Fewer eyes on them. And that's where true opportunities often hide.
Okay, so having explored how to think differently in the market and challenged the idea that markets are perfectly rational,
That lays the groundwork for understanding the true heart of Marx's philosophy, the inseparable pillars of value, price, and risk.
absolutely. So let's talk about the indispensable role of intrinsic value. Marx emphasizes repeatedly that investment success comes from buying things well, not just buying good things.
A crucial distinction.
And the absolutely non-negotiable starting point for any intelligent investing, according to Marx, is an accurate, disciplined estimate of a security's intrinsic value. Paul Johnson calls this concept the first building block of value investing.
This principle is fundamentally about avoiding fads, ignoring hype, and resisting the urge to chase what's hot. Marx is highly dismissive of momentum investing.
Just following the price chart.
Yeah, relying purely on past price movements and technical indicators. He calls it not a cerebral approach. He points directly to the legions of day traders during the 1998-1999 tech boom, who focused entirely on price momentum, disregarding any concept of intrinsic value.
And what happens then?
Well, he asks, what happens when, if something cannot go on forever, it will stop? Their strategies were built on sand, essentially. They blew up.
He deepens the distinction between value and growth investing, which are often presented as opposites.
Right, like their enemies.
Value investors, he explains, aim to ascertain a company's current intrinsic value and buy when the price is lower, focusing on tangible financial metrics like earnings, cash flow, assets.
Hard numbers.
Growth investors, on the other hand, seek companies whose value will increase rapidly in the future, emphasizing potential over current attributes.
So Marx clarifies it's not really value versus growth, but more accurately, value today versus value tomorrow. Both are ultimately about value, just at different points in time.
It's a really helpful framing.
And Joel Greenblatt notes that Warren Buffett's major contribution was extending the traditional idea of value beyond simply cheap, low PE, low price to book.
Cigar butts.
Exactly, cigar butt investing. Buffett extended it to encompass good businesses available at an attractive price. This acknowledges that robust, growing businesses, even if they don't look cheap on static metrics today, can represent immense value if purchased at a reasonable price relative to their substantial future potential.
So buying quality at a fair price.
In fact, buying a great business at a fair price is perhaps the ultimate form of value investing, according to this view.
To really illustrate the perils of unbridled growth mania and ignoring intrinsic value, Marx revisits the famous Nifty 50 example from the late 60s and early 70s.
The one-decision stocks.
Right. These were 50 supposedly unassailable companies. IBM, Xerox, Kodak, Polaroid, deemed so dominant that investors were willing to pay truly exorbitant prices. They thought nothing could go wrong.
Famous last words.
Indeed. Fast forward a couple of decades, and many of these businesses were decimated by unforeseen technological changes and competitive forces, proving that no company is immune to change.
Christopher Davis offers a fascinating and important counterpoint here, though. He notes that while some Nifty 50 companies did indeed perform poorly or even disappeared,
Like Kodak.
right, but some others, like Coca-Cola or Philip Morris, compounded returns for decades if held patiently, highlighting the complexity and the miracle of compounding for truly exceptional businesses.
So it wasn't all bad.
It shows that while the initial valuation for some on the list was extreme and unsustainable, the underlying business quality for a select few still offered tremendous long-term returns if you were able to hold through the volatility and the sometimes painful valuation adjustments. It's a reminder that even in an extreme bubble, not everything is equally bad. You still need to analyze the individual business.
Marx uses a batting average analogy to bring this home. He argues that it's inherently harder to see the future than it is to assess the present.
Makes sense.
Meaning growth investing generally has a lower batting average. Value investors, by contrast, simply aim to be right about an asset's current value and then buy it for considerably less.
And that's where Seth Klarman chimes in. He adds, ideally considerably less. The bigger the discount, the bigger your margin of safety.
The margin of safety. Classic Graham and Dodd.
Absolutely. This margin of safety provides a buffer against unforeseen problems and acknowledges the inherent uncertainty in even the best estimates of value.
So your strong view of intrinsic value becomes the absolute foundation for conviction.
It's what gives you the confidence to hold on when the market is pessimistic and the discipline to sell when euphoria takes over. An accurate opinion on valuation, loosely held, is of limited help.
But an incorrect opinion, strongly held.
That's far worse, a recipe for disaster. The goal is to develop an accurate opinion, hold it with conviction, and wait patiently for the market to eventually agree with you.
So once you have an idea of intrinsic value, how does that relate to what the market actually prices something at? This brings us to the dynamic and often bewildering relationship between price and value.
And Marx stresses once more that investment success doesn't come from buying good things, but rather from buying things well. The price you pay is paramount.
Always comes back to price.
Always. While fundamental value is critical, a security's short-term price fluctuations are primarily determined by two other powerful factors that often override fundamentals: psychology and technicals.
Okay, technicals first. What are those?
Technicals are non-fundamental factors affecting supply and demand. Think forced selling during crashes due to margin calls, or forced buying by mutual funds because of large inflows they suddenly receive.
Things unrelated to the company's actual performance.
Exactly. Marx recalls making some of his very best buys during such moments, emphasizing that nothing is better for a buyer than purchasing from someone who has to sell, regardless of the price. That creates an artificial, temporary supply-demand imbalance that clever investors can exploit.
Okay, and the other factor, psychology.
Psychology is arguably paramount. Marx dedicates multiple chapters to it for a reason. Investor psychology can cause prices to deviate wildly from fundamentals in the short run, sometimes for extended periods.
This is where it gets messy.
It does. Joel Greenblatt notes that Warren Buffett would often teach his students not just how to estimate intrinsic value, but crucially, also how to think about market prices. Merely understanding that prices can deviate wildly from value is key.
But the hard part.
The truly hard part is understanding the psychology that causes these deviations, and then being able to take advantage of them. It requires a profound understanding of human nature, including your own biases and emotions.
Marx describes investing as, at its core, a popularity contest.
That's a great way to put it.
And the most dangerous thing you can do, he warns, is to buy something at the peak of its popularity, because at that point, all favorable facts are already fully priced in.
And critically.
Critically, there are no new buyers left to push the price higher. Everyone who might buy already has.
So the path of least resistance is down. Conversely, he emphasizes the safest and most potentially profitable thing is to buy something when no one likes it.
Buying the unloved.
Exactly. Given enough time, its popularity and thus its price can often only go one way, up as the market eventually comes to recognize its true value or the negative sentiment fades.
This brings us directly to the illusion of bubbles. How do they form?
Bubbles, Marx explains, almost always start with a nugget of truth, a genuine innovation, a promising new technology, maybe a period of strong economic growth, something real.
But
they are quickly fueled by investors becoming inflamed by the possibility of easy money. causing them to think less and less about fair price and more about just getting in on the action.
FOMO kicks in, fear of missing out.
Big time. People irrationally like things more as their price rises, and that upward momentum becomes its own reason for buying. Joel Greenblatt highlights this uncanny human tendency to be attracted to recently well-performing investments, often ignoring the very real risks. It's a primal, almost tribal urge.
And this leads directly to what's known as the greater fool theory.
Right. You buy something not because of its intrinsic value, but because you're convinced someone else will pay me more for it. A greater fool.
Works until it doesn't.
Precisely. This strategy works perfectly, right up until the moment it doesn't. Eventually, fundamental valuation comes back into play, or the supply of greater fools simply runs out, leaving those holding the bag to face painful, often catastrophic, losses.
So, given all this psychological noise and potential for bubbles, what's the most reliable route to profit?
Of all investment strategies, Mark says buying cheap is clearly the most reliable path, buying below intrinsic value.
But even that's not foolproof.
No, even then, it's not infallible. You could be wrong about your value estimate, unforeseen events could suddenly reduce that value, or prevailing negative attitudes could cause it to sell even further below value for a long, long time.
Which brings us back to Keynes.
Exactly. As the great economist John Maynard Keynes famously pointed out, and Marx loves to quote him, the market can remain irrational longer than you can remain solvent. This connects deeply to Marx's point about the fear of looking wrong. It explains that even correct judgments might take a painfully long time to materialize, testing your conviction and your staying power, making you look foolish in the short term.
Okay, building on this vital discussion of price and value, we move to what many consider Marx's single greatest contribution to investment wisdom: understanding and recognizing true risk.
And Paul Johnson, in his annotations, strongly states that Marx's discussion of risk across chapters 5, 6, and 7 is the most comprehensive and complete he has ever seen in any investment text.
That's incredibly high praise. So why exactly is risk assessment so essential?
Marx provides three powerful, interconnected reasons. First, he says, risk is fundamentally a bad thing, and level-headed people inherently want to minimize it. You want to control your downside. Makes sense.
Okay.
Second, all rational investment decisions should be a function of both risk and return. In other words, higher expected returns should always be demanded as compensation for taking on higher risk. You should never take risk for free.
No free lunch.
Right. And third, a particular investment return means very little without understanding the risk taken to achieve it. Was that 15% return achieved with safe government bonds or highly speculative penny stocks? With or without excessive leverage? In a concentrated or diversified portfolio? The how matters as much as the what.
This is where Marx absolutely hammers home his critical distinction. Risk is not volatility.
He's adamant about this. While academics, for their models and convenience, adopted volatility as a proxy for risk because it's objective and easily quantifiable.
Easy to measure.
Right. But Marx argues that real-world investors are primarily worried about permanent loss of capital, not just temporary price fluctuations. He challenges you directly. I've never heard anyone say, I won't buy it because its price might show big fluctuations.
People worry about losing their savings, not about the daily ups and downs so much.
Exactly. People don't lose sleep over market swings. If they believe the value is intact, they lose sleep over their money being gone forever. Volatility is just a symptom, he argues, not the disease itself.
He powerfully visualizes this with his own figure 5.2, contrasting it with the simplistic conventional risk-return line, that upward-sloping line you always see.
Yeah, Marx's version is different. It illustrates that riskier investments don't just have a higher single expected return. They have a wider range of possible outcomes.
Or uncertainty.
Exactly, emphasizing the inherent uncertainty and the greater possibility of painful downside, not just bigger upside. Joel Greenblatt further highlights that, in reality, the actual outcome distribution for investments is rarely, if ever, normally distributed. It's fat-tailed and skewed.
Meaning extreme events happen more often than models predict.
Far more often. This greater uncertainty, the possibility of surprising and unpleasant results, is, for Marx, the very essence of riskier investments.
Beyond just permanent capital loss, Marx identifies several other crucial types of risk that thoughtful investors must consider.
Yeah, because risk isn't monolithic. It affects different individuals and institutions differently. For example, there's the highly personal risk of falling short of one's goal.
Like retirement needs.
Exactly. Think about it. A young saver, decades from retirement, might be perfectly fine with more volatility, hoping for higher long-term returns.
Yeah.
But a retiree counting on a fixed income stream from their portfolio has a very different and much lower definition of acceptable risk. Their goal is preservation, not aggressive growth.
Makes sense. What else?
Then there's underperformance risk, the risk of lagging the overall market, especially during periods of irrational exuberance when you're sticking to your disciplined, value-based approach.
That must be psychologically tough.
Incredibly tough. Joel Greenblatt shares a surprising statistic here. 79% of top quartile managers in the 2000s spent at least 3 years in the bottom quartile.
Wow, almost 80%.
Yeah. It's a powerful caution against chasing hot funds or abandoning your strategy just because others are temporarily outperforming you. Sticking to your guns can mean periods of looking wrong.
And we can't forget career risk for professional money managers.
Oh, definitely. If they take a truly unconventional but potentially correct long-term position that underperforms for a few quarters, they might face intense pressure from clients or even lose their job, even if they're eventually proven right.
So that pushes them towards consensus thinking.
Often, yes. It forces conformity to the crowd, which, as we've discussed, suppresses opportunity for superior returns. And then there's illiquidity risk.
Being stuck.
Right. Being unable to quickly sell an investment at a fair price when you absolutely need the cash. Imagine owning a piece of real estate or a private equity stake during a market freeze. You might be rich on paper, but unable to access your money. These are all very real, tangible risks that a simple volatility metric alone simply cannot capture.
So where does the risk of actual loss come from primarily?
Marx argues that the risk of loss primarily stems from too high prices, not necessarily weak fundamentals alone.
So price again.
Always price. A fundamentally weak asset can actually be a hugely successful investment if it's bought cheaply enough, with sufficient margin of safety. Conversely, a fundamentally sound asset can be a terrible investment if bought at an exorbitant price. Christopher Davis completely agrees, stating that high price both increases risk and lowers return. It's a double whammy.
What's truly fascinating here is Marx's perspective that much of risk, particularly looking forward, is subjective, often hidden, and inherently unquantifiable.
You can't just plug it into a formula.
Right. It cannot be machinable or turned over to a computer with a simple algorithm, as legendary value investors Ben Graham and David Dodd pointed out over 60 years ago. They noted that the relationship between different kinds of investments and the risk of loss is entirely too indefinite and too variable with changing conditions to permit of sound mathematical formulation.
This leads directly to the concept of the improbable disaster. Risk is deceptive because conventional considerations, things like debt levels, earnings growth, market share, are relatively easy to factor in. We know how to analyze those.
But the curveballs.
But those freakish, once-in-a-lifetime events, what Nassim Nicholas Taleb brilliantly calls outliers or black swans, those highly improbable but massively impactful occurrences are incredibly hard to quantify and even harder to anticipate.
But we underestimate them.
Consistently. An investment can seem much safer than it truly is because people consistently underestimate the potential for these rare disruptive events. Mark's brilliantly simple explanation of the 2008 credit crisis, which Paul Johnson praises as brilliantly simple.
What was it?
He said it was simply that never-before-seen events collided with risky, levered structures that weren't engineered to withstand them. It was a collision of the unpredictable with the over-leveraged and fragile.
And one of the most insidious and dangerous sources of risk, directly contributing to the formation of bubbles, is what Marx calls the risk is gone myth.
Ah, complacency.
Exactly. This is when investors collectively believe that risk is low or has somehow disappeared from the market. When this happens, they accept risk without demanding adequate compensation, like higher interest rates or lower PE ratios.
Which pushes prices too high.
Exactly, which in turn drives prices too high, making the investments themselves much riskier. Marx states, "There are few things as risky as the widespread belief that there's no risk."
Joel Greenblatt uses a powerful analogy here, the avalanche expert metaphor. Better safety gear like airbags for skiers can, counterintuitively, entice climbers to take more risk, maybe skiing steeper slopes, making them less safe overall.
Interesting paradox.
Marx explicitly links this to his New York Times piece, Too Much Trust, Too Little Worry, where he argues that unworried, complacent investors are, in fact, their own worst enemy. They create the conditions for the next crisis.
This understanding of risk, far beyond mere volatility, sets the stage for understanding market dynamics and human nature. particularly the inevitable cycles and pendulum swings.
That are a constant feature of financial markets, absolutely.
This is a fundamental truth for Howard Marks. Everything is cyclical. Nothing in investing, or in life for that matter, goes in one direction forever.
It's a core tenet.
He quotes a powerful adage that should be etched into every investor's mind. Trees don't grow to the sky. Few things go to zero.
Simple but profound.
He stresses that success itself often carries the seeds of failure, and conversely, failure carries the seeds of success, because prevailing trends tend to create the very reasons for their own reversal. Good times lead to complacency and excess. Bad times lead to prudence and opportunity.
And the greatest danger here, of course, is falling prey to the "this time it's different" premise, the four most dangerous words in investing.
Exactly. Marx vividly exposes this dangerous premise by recalling a Wall Street Journal report from 1996, just before the dot-com bubble, which confidently claimed the business cycle had been tamed and recessions were a thing of the past.
Famous last words again.
This blissful ignorance was then sharply contrasted with the emerging market crisis of 1998, the 2002 recession, and of course, the cataclysmic 2008 financial crisis. Paul Johnson notes how Marx's decade-old memos on cycles read as fresh and relevant today.
It shows that history repeats, or at least that man has a tendency to repeat history. The details may change, the technology evolves, but basic human behavior remains remarkably consistent across cycles.
Marx's favorite cycle, due to its sheer inevitability and extreme volatility, is the credit cycle.
He talks about this one a lot.
He describes a clear, predictable process. Good economic times lead to a shrinking perception of risk, which makes lenders eager to lend. This, in turn, leads to a loosening of credit standards, with money flowing into increasingly unworthy projects.
Fueling the boom.
Right. This eventually results in massive capital destruction as those projects inevitably fail. This entire process then reverses dramatically in bad times, as defaults and bankruptcies become widespread and lenders suddenly become reticent, tightening credit to a painful degree.
As The Economist famously put it, the worst loans are made at the best of times. When everyone feels good is when the biggest mistakes happen.
This cyclicality also links deeply to the pendulum-like oscillation of investor attitudes. It swings wildly from extreme optimism to deep pessimism.
From greed to fear.
Greed to fear, from gullible credulity to cynical skepticism. Marx notes that this pendulum rarely, if ever, rests at the rational midpoint. Instead, it spends most of its time swinging towards the emotional extremes.
Paul Johnson sees this chapter as a direct extension of the 3 earlier chapters on risk, helping you to analyze and understand the current risk temperature of the market by observing these emotional swings. Where is the pendulum now?
Marx has a famous and incredibly insightful observation about the 3 distinct stages of a bull market. Remember these?
Oh, yes. Stage 1.
The first stage is when a few forward-looking people begin to believe things will get better. These are the shrewd contrarians, buying when others are still hesitant or fearful.
Stage 2.
The second stage is when most people realize things are, in fact, getting better. This is when the trend is established, the news turns positive, and the majority starts to pile in.
And the dangerous third stage.
And the third, most dangerous stage is when everyone is convinced things can only get better. This is the peak of euphoria, where risk is ignored, caution is thrown to the wind, and prices become detached from fundamentals.
That's when you need to be most careful. He emphasizes that the market has a mind of its own, often independent of pure fundamentals, and that changes in valuation are frequently driven by shifts in psychology, not just underlying business performance.
The profound significance of recognizing these inevitable swings offers huge opportunities for discerning investors.
Absolutely. At the darkest of times, when extreme fear and pessimism grip the market, the few individuals with analytical ability, objectivity, and the sheer resolve to act can make unusual profits with remarkably low risk, precisely because prices are so depressed.
Buying when there's blood in the streets.
Even if it's your own, as the saying goes. Conversely, when everyone assumes and prices in the impossible improvement forever, the stage is set for painful losses for those who join the crowd late in the game.
Joel Greenblatt, ever the opportunist, adds that markets will always create opportunities, whether now or later.
Which emphasizes the absolute importance of patience and waiting for those emotional extremes to manifest. Don't force it if the opportunities aren't there.
So if cycles are inevitable and human emotions swing wildly, what's truly causing these recurring mistakes among investors? Why don't we learn?
Marx says, unequivocally, that mistakes occur because investing is undertaken by human beings, most of whom are at the mercy of their psyches and emotions. It's just baked into our nature.
And Christopher Davis adds that perverse incentives can influence institutional investors' decision-making in negative ways, too.
Right, pushing even professionals toward irrational behavior due to career risk or benchmarking pressures. It's not just individuals.
This is a critical insight. Psychological influences have immense power over investors.
Immense. Most unfortunately succumb to these forces, permitting investor psychology to dictate the wild swings of the market. When those forces push markets to the extremes of a bubble or a crash, they create incredible opportunities for superior investors by allowing them to refuse to hold assets at irrationally high prices and by insisting on buying them at irrationally low ones. Resisting these inimical forces, this powerful emotional tug, is an absolute requirement for successful investing. Easier said than done, of course.
Marx identifies several key psychological pitfalls that trip up even intelligent people. First, greed.
Not just wanting to make money.
No, this isn't just the desire for money, which is natural. Rather, he says, it morphs into inordinate acquisitiveness, an insatiable hunger that overrides common sense, risk aversion, and prudence. Marx describes it as an extremely powerful force.
It can cause people to take truly destructive actions, buying anything and everything in the hopes of quick, easy riches, ignoring all warning signs.
Second, the willing suspension of disbelief.
This is where investors dismiss logic, historical lessons, and time-honored financial norms, choosing instead to accept increasingly unlikely propositions and speculative theories. This time, it's different thinking.
Marx uses the vivid Peter Pan analogy. In fiction, we don't care if we can see the wires holding Peter Pan aloft because we want to believe it's part of the fun.
But in investing,
he cautions, you must constantly be on the lookout for those wires, for the things that simply can't work in real life. Charlie Munger's quote of Demosthenes is apt here. Nothing is easier than self-deceit, for what each man wishes, that he also believes to be true.
we see what we want to see, not what is actually there. A dangerous bias.
Third, and this is a profound one, the extreme brevity of financial memory, a powerful phrase Marx borrows from John Kenneth Galbraith.
We forget so quickly.
Right. This is the tendency for investors to quickly forget past crises, bubbles, and crashes, dismissing history as primitive refuge, irrelevant to the new paradigm. Joel Greenblatt candidly admits many of his own mistakes came from this very flaw.
This short-term memory, combined with an unskeptical belief that a silver bullet for easy high returns is just around the corner, eventually leads to what Marx calls capital punishment, painful losses. Greenblatt adds that, much like rumors, these alluring theories need a germ of truth to be believed, which makes them all the more dangerous.
Fourth is the powerful influence of the crowd, or herd mentality.
Following the herd.
Marx cites Solomon Asch's famous conformity experiment, where people ignored their own senses and objective reality just to side with the majority, leading to profoundly flawed consensus decisions.
In investing, this manifests as a strong desire to be part of the winning group, to not miss out. Joel Greenblatt highlights that most institutional and individual investors benchmark their returns against others, causing them to chase the crowd rather than think independently. The pressure to conform, to not look wrong in the short term, is immense.
Fifth and sixth are ego and envy.
Oh, these are big ones. Ego drives investors to behave aggressively, often taking excessive risks to achieve lofty results, and stand out from their peers, frequently seeking celebrity over truly stellar risk-adjusted returns.
And envy.
Envy makes them constantly compare themselves to others, seeing someone else's temporary wins and leading to deep frustration and poor impulsive decisions driven by a fear of missing out. Marx states the road to investment success is usually marked by humility, not ego.
It's hard, though.
It is incredibly painful to look wrong when others seem to be winning, and this emotional pressure can profoundly distort judgment, leading even disciplined investors astray, keeping up with the Joneses financially.
The dot-com bubble of the late 1990s is Marx's perfect, vivid case study for psychology at work, illustrating almost every pitfall we've just discussed.
It had it all. It was a period defined by a powerfully strong market, genuinely revolutionary tech innovation, lionized entrepreneurs who became household names, and relentless, almost vertical stock appreciation.
And people found reasons to justify it.
Oh yeah. Logical theming rationales for ever higher prices emerged everywhere. Tech stocks must keep appreciating because the internet changed everything. Index funds must buy them as they enter the indices, creating forced demand. Marx soberly notes, the fact that all of these phenomena actually occurred for a while lent credence to this theory. making it incredibly difficult to argue against the prevailing narrative.
IPO mania was rampant during this period. Remember that.
Vividly. New tech stocks, many with no earnings or even revenue, were appreciating by tens and even hundreds of percent on their issue day. They were seen as sure winners that couldn't possibly go down.
People didn't ask why.
No, people didn't ask why these young geniuses were succeeding with such unprecedented speed. They simply assumed it was due to astuteness and a new economy, not irrational market behavior. They completely ignored any concept of intrinsic value, focusing purely on price momentum. Get rich quick.
Predictably, as with all bubbles, it burst.
Of its own weight, as Marx puts it. Tech stocks lost 90% or more of their value, and often over 99%. Millions of individual investors and many professional ones were financially devastated.
Buffett's analogy about aviation seems relevant here.
Absolutely. Aviation is a massively valuable innovation for humanity, but it has historically been a terrible business for investors due to massive capital destruction. Similarly, tech innovation was real and transformative, but the valuations placed on many companies during the bubble were utterly irrational and unsustainable.
The profound lesson here is undeniable. Greed, excitement, illogical thinking, the willing suspension of disbelief, and the complete ignoring of fundamental value cost people immense sums of money.
And disciplined value investors who stuck to their principles looked dumb and outdated for months and even years as the bubble inflated. They faced constant criticism and peer pressure.
Until they didn't look dumb anymore.
Right. As Marx so eloquently puts it in his annotation, disciplined value investors look like pessimists, grumps, or old fogies, until they turn out to be among the few who protected against losses when the inevitable correction comes. Vindication, but often after a painful wait.
So, to avoid losses in future bubbles, the clear call to action for you, the thoughtful investor, is to absolutely refuse to join the crowd when greed distorts judgment and pushes prices to unsustainable levels.
And conversely, in crashes, you must avoid selling, and preferably be buying, when fear is excessive and pushes prices to irrational lows. You have to fight your own instincts.
Marx concludes with a timeless observation. Bubbles are capable of arising on their own and need not be preceded by crashes, whereas crashes are invariably preceded by bubbles.
The crash is simply the inevitable unwinding of the bubble's excesses. One leads to the other.
This powerful understanding of human psychology and market cycles brings us to strategic approaches for thoughtful investors, starting with the counterintuitive yet essential practice of embracing contrarianism.
Truly walking the path less traveled. Sir John Templeton's famous quote sets the perfect tone. To buy when others are despondently selling, and to sell when others are euphorically buying takes the greatest courage, but provides the greatest profit.
Clear enough. Superior investors are fundamentally the opposite of trend followers. They are anti-trend.
Paul Johnson notes that while contrarianism is immensely challenging to teach, it is absolutely essential for achieving truly differentiated results. You can't get extraordinary results by doing ordinary things.
The logic of crowd error is remarkably simple and consistent, as Marx lays it out.
Yeah, bull markets occur because buyers predominate, pushing prices ever higher. A market top occurs precisely when the last person who will become a buyer does so.
No more buyers left.
Right. Once there are no new buyers left, there's no further upward pressure on price, and the only direction left is down. Conversely, bear markets see sellers predominate, driving prices lower. A market bottom occurs when the last person who will become a seller does so.
Total capitulation.
Exactly. Once all the weak hands have capitulated and sold, there are no new sellers, and prices can only go up. This highlights the precise moment, the point of maximum pessimism or optimism, for contrarians to act.
But, and this is a crucial caveat, being early is incredibly difficult. You can be right eventually, but wrong for a long time first.
Marx has a famous adage that captures this pain. Being too far ahead of your time is indistinguishable from being wrong. He candidly acknowledges the profound discomfort and potential career risk of being early.
Standing alone while the crowd parties on.
Right. Standing alone while the crowd continues to revel in euphoria. But he stresses that it's much better to get off too soon than to stay on past the peak. The temporary pain of being early is far preferable to the permanent losses of being late.
Seth Klarman adds that it's vital to remember you own a fractional interest in a real business, not just a stock price ticker.
A grounding thought. When prices decline, you're able to buy into that underlying business at a greater discount to its intrinsic value, making it a stronger long-term investment, even if the price keeps falling for a while.
David Swenson, the legendary Yale endowment manager, in his book Pioneering Portfolio Management, beautifully describes the inherent discomfort of the unconventional path.
He writes that active strategies demand uninstitutional behavior from institutions, requiring acceptance of uncomfortably idiosyncratic portfolios that frequently appear downright imprudent to the conventional mind.
Marx notes that those very words, uninstitutional, idiosyncratic, imprudent, lonely, and uncomfortable, perfectly highlight the immense psychological and professional challenge of being a true contrarian. It's not for the faint of heart.
No, definitely not.
Marx himself had an epiphany about the true nature of skepticism in October 2008 during the depths of the global financial crisis.
He realized that skepticism calls for pessimism when optimism is excessive and risk is being ignored. That's the usual understanding.
But the other side.
But also for optimism when pessimism is excessive and panic is widespread. The ultimate act of contrarianism in the 2008 crisis, when the world seemed to be ending, was being optimistic and having the courage to buy when almost no one was saying, no, things can't be that bad.
That took guts.
Absolutely. Joel Greenblatt highlights the spectacular once-in-a-lifetime returns generated from that period for those with the conviction and capital to be contrarian buyers amidst the panic.
As contrarians, Marx says it's our job to catch falling knives, hopefully with care and skill.
This isn't about blindly buying everything that's falling, obviously. It requires a strong, independent sense of intrinsic value to know when something truly represents a bargain, when the selling is indiscriminate and driven by fear, not fundamentals.
The immense reward for successful contrarianism is well articulated. It's the ability to buy what everybody else underestimates.
To acquire assets for pennies on the dollar because the market is gripped by fear or complacency. Marx concludes that the lonely and uncomfortable position should not just be tolerated, it should be celebrated, because it's the path to superior results.
This naturally leads us to the art of finding bargains and practicing patient opportunism. Bargains, for Marx, are the holy grail of investing.
They offer incredibly unusual ratios of potential return to risk. They exist, he says, when perception has to be considerably worse than reality, when the market's view of an asset is far more negative than its underlying fundamentals justify.
And the very best opportunities.
They are found where most others won't do, in those unpopular, overlooked, or misunderstood corners of the market, where there's complexity, distress, or just plain neglect.
How exactly are bargains made? Where do they come from?
They primarily arise from irrationality, incomplete understanding, or various biases among other investors. Marx illustrates this with powerful examples from his own illustrious career.
Like what?
He found immense opportunities in backwaters, like convertible securities, which were shunned by most equity and bond investors. Then, famously, he found value in high-yield bonds, once considered taboo or junk for institutional investors because of their perceived risk.
And distressed debt.
Later, distressed debt investments in companies on the brink of bankruptcy was seen as beyond the expertise or acceptable risk profile of most. But these areas, precisely because they were shunned and misunderstood, became incredibly profitable for Marx's firm, Oaktree Capital. Joel Greenblatt highlights this as outlining opportunities for both traditional value investing and specialized special situation investing.
What's equally important and often overlooked is patient opportunism.
Right. Marx explains there simply aren't always great things to do, especially in an efficient or fairly valued market. Sometimes, maximizing your contribution as an investor means being incredibly discerning and relatively inactive.
Holding cash, waiting.
Exactly. Waiting patiently for truly compelling bargains to emerge, rather than feeling compelled to constantly do something, to always be fully invested. This is about waiting for the market to offer you bargains, rather than trying to create them in a frothy environment or reaching for return by taking on undue risk in a low-return world.
He paints a vivid picture with his famous cat, tree, carrot, and stick allegory. Can you walk us through that?
Sure. Imagine. The cat represents the investor, desperately trying to cope with its environment. The tree symbolizes the investment environment, full of available opportunities, some safe, some risky.
Okay.
The carrot, tantalizingly placed further up the tree, represents the lure of higher apparent returns from riskier investments. And the stick, prodding the cat from behind, represents the low prospective returns from safer, conventional investments, motivating it to forsake safety.
So the cat feels pressure from both ends.
Exactly. Together, the stick, low safe returns, and carrot, high risky returns, compel the cat to climb higher and higher up the tree into increasingly treacherous, riskier strategies, pursuing high returns even when the environment simply doesn't justify them. Marx warns against this dangerous impulse to reach for return.
Christopher Davis and Seth Klarman emphasize that chasing a fixed return requirement, especially in a low-return world, is incredibly dangerous.
Because it forces you to accept higher risk and lower quality investments simply to hit an arbitrary number, regardless of the underlying value or risk involved.
The absolute best buying opportunities, Marx asserts, occur when asset holders are forced to sell.
Often regardless of price, due to margin calls, contractual obligations, or simply the desperate need to raise cash. Marx calls, regardless of price, the most beautiful words in the world to a potential buyer.
He recounts the detailed, exhilarating example of the senior bank loan market in Q4 2008.
Right. During that financial meltdown, leveraged investors who had borrowed heavily to buy these loans were wiped out by cascading margin calls, creating what Marx calls ridiculous selling prices, panic selling.
Which created massive opportunity.
Immense, almost unprecedented opportunities for patient opportunists who had the capital and foresight to step in when everyone else was fleeing. Paul Johnson stresses that while this is excellent advice, it is extremely challenging to follow in the heat of a crisis when fear is palpable.
To be a buyer when others are forced sellers, when the market is in free fall and everyone else is desperate to unload, what does that take?
An investor needs to be completely insulated from those same forces. This requires an unwavering, staunch reliance on intrinsic value, little to no leverage in your own portfolio, truly long-term capital that is beholden to short-term withdrawals, and perhaps most importantly, a very strong stomach to withstand the surrounding panic and uncertainty.
This brings us directly to mastering risk control, investing defensively. Marx asserts that truly outstanding investors are distinguished as much by their ability to control risk as by their uncanny knack for generating spectacular returns.
It's often overlooked. He notes that risk control is often invisible in good times, because losses only become observable when inherent risk actually collides with negative events. People rarely gain recognition for their prudence in good times. It's simply assumed or ignored.
Until things go wrong.
Exactly. Marx explains that the true alpha, that unique value added through skill beyond what the general market gives you, beta, is achieving the same return with less risk in an inefficient market.
That's the real skill.
To him, this is a great accomplishment, far more impressive than simply generating higher returns by taking more systematic market risk. Joel Greenblatt emphasizes that finding such truly skilled talent requires diligently assessing an investment process, not just looking at past returns, which can be heavily influenced by luck.
And the power of risk control. It primarily delivers what he calls losses that don't happen.
These what-if calculations, the potential disasters you successfully avoided by being prudent, are hard to appreciate in placid times, but are the true fruit of defensive investing. It's like a prudent homeowner meticulously carrying insurance even when there's no fire in sight.
The value is only fully understood when disaster strikes and you are protected.
Exactly. The principal pitfalls that lead to massive losses, Marx explains, come from an inability to truly know how bad is bad, and from relaxing your rules or increasing leverage when extreme volatility and loss surface only infrequently. Commodity creeps in.
He uses Nassim Nicholas Taleb's Russian roulette analogy again.
Right. People forget the bullet exists in a multi-chambered revolver because it doesn't fire often, leading to a numbing false sense of security. Investors too often fixate on likely scenarios and gravely underestimate the potential for outliers or black swans.
And his explanation for 2008.
Marx's powerfully simple explanation of the 2008 credit crisis, which Paul Johnson rightly praises as brilliantly simple, was that never-before-seen events collided with risky, levered structures that weren't engineered to withstand them. The system wasn't built for the storm.
Marx clarifies Oaktree's philosophy regarding risk. They don't run from risk itself.
No, rather, they welcome it at the right time, in the right instances, and at the right price. Blind risk avoidance, he cautions, inevitably leads to return avoidance. You can't make money hiding under the bed.
So it's about intelligent risk-taking.
What they practice instead is risk intelligence, the ability to discern, measure, and then prudently take on risk when it is adequately compensated, not to avoid it altogether.
Oaktree's core belief and a guiding principle for Marx is summed up in their powerful motto: if we avoid the losers, the winners will take care of themselves.
This means going for a high batting average, emphasizing consistency and avoiding major errors, rather than chasing home run spectacular but often inconsistent gains. Christopher Davis notes the subtle danger of hiding only in perceived safe investments, as this can still lead to significant underperformance relative to your goals, even if you don't suffer outright capital loss. You might not lose money, but you might not make enough either.
The ultimate advice from Marx: invest scared.
He urges you to constantly worry about the possibility of loss, about what you don't know, about the potential for bad luck. This isn't about being paralyzed by fear, but about maintaining a healthy, persistent skepticism. Paul Johnson unequivocally urges all investors should heed this advice. It's a proactive, defensive mindset.
There's an undeniable paradox here, though, that Marx acknowledges.
Which is?
To materially help your return, to truly move the needle, you inevitably have to commit enough capital to an investment that it could materially hurt you if it fails. You have to make meaningful bets.
Marx attributes this inherent dilemma to the fear of looking wrong, which is a powerful human emotion. This fear prevents investors from adopting the necessary, lonely, contrarian positions that are often the most profitable, because those positions inherently carry the risk of short-term underperformance and looking foolish to the crowd.
If you're dominated by an unwillingness to ever be wrong or look wrong,
you'll never be able to adopt these truly differentiated and profitable positions. You'll stick too close to the benchmark, guaranteeing average results.
So shifting gears slightly, we come to a profound Marxian lesson about the unknowable and its implications for you, the investor. First, the crucial concept of knowing what you don't know, the illusion of prediction.
The great John Kenneth Galbraith famously quipped, "We have two classes of forecasters, those who don't know and those who don't know they don't know."
Chuckles love that quote. Marx wholeheartedly agrees, arguing that the macro future things like the economy's direction, interest rates, or the overall market's trajectory is largely, perhaps entirely, unknowable with any consistency.
Paul Johnson's sharp advice here is simple but potent. Be very careful with your own forecasts and even more careful with those of others. Assume they're probably wrong.
Marx details his own empirical study of Wall Street Journal economic polls. What did he find?
He consistently found that professional forecasts were generally inaccurate and provided little to no valuable insight, especially when it came to predicting major changes or turning points in the market or economy. They were good at predicting continuation, terrible at predicting change.
And no one was consistently good.
No. He found that winning forecasts were rarely, if ever, consistent from the same individual. Someone might get one big call right, maybe get lucky, but then be spectacularly wrong for years afterward, demonstrating that it was often more luck than skill.
So if investment results are determined by an unknowable future, how on earth do you cope with that profound uncertainty? How do you invest?
Paul Johnson calls this the ultimate investing challenge. Marx beautifully distinguishes between two schools of thought that attempt to answer this, the I know school and the I don't know school.
Okay, the I know school.
The I know school comprises those who believe they can foresee the future. They tend to make assertive, directional bets, concentrate their positions heavily, and often use leverage to amplify their perceived insights. They are, quite naturally, sought out for their opinions and appear frequently on financial news programs. They sound confident.
And the I don't know school, Marx school.
To which Marx himself firmly belongs, yes. They acknowledge that the macro future is largely unknowable. Their focus is instead on doing the absolute best job of investing in the absence of that knowledge. They prioritize defensive investing and actively avoiding pitfalls, knowing that avoiding major losses is paramount.
It comes back to that quote.
Exactly. Marx's famous quote perfectly encapsulates this philosophy. It ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. Overconfidence is the real killer.
And here's the powerful insight. Acknowledging the boundaries of what you can know actually provides a tremendous advantage.
How so?
It allows you to work within those limits, to focus on the knowable, like assessing individual company fundamentals, industry dynamics, management quality, rather than venturing foolishly beyond them into the realm of pure speculation about macro events. It's a profound act of intellectual humility that leads to better decisions.
This profound humility connects directly to appreciating the crucial role of luck, understanding the distinction between randomness and genuine skill. Nassim Nicholas Taleb's profound influence on Marx's thinking is evident throughout this section.
Marx emphasizes that randomness or sheer luck plays a massive part in investment outcomes, far more than most people acknowledge or want to admit.
He uses a striking analogy. A $10 million fortune earned through a game of Russian roulette is simply not the same as $10 million earned through decades of diligent dentistry, even if the accounting balance sheet looks identical. The dependence on randomness, the process by which the money was earned, is fundamentally different. One involves skill and prudence, the other blind luck and extreme risk.
Marx introduces Taleb's concept of alternative histories. What's that?
He argues that every investment record, every successful portfolio, should be considered in light of all the other outcomes that could have occurred, but didn't due to luck.
Yeah.
How many times did they almost blow up, but got saved by chance?
So you can't just look at the final result.
No. In the short run, he explains, spectacular success can often be due to little more than sheer luck, combined with a healthy dose of boldness, not genuine skill. It's incredibly hard to tell a lucky idiot from a truly skilled investor without long-term data that spans multiple market cycles.
Seth Klarman reinforces this point, emphasizing that it's all important to look not at investment results, but at investment process.
Did they get lucky, or did they follow a sound, repeatable process that makes sense independent of the outcome? That's the key question.
This drives home the crucial distinction between what Marx calls a good decision and merely a profitable decision.
They're not the same thing. A good decision is one that a logical, intelligent, well-informed person would make before the outcome is known, based on sound analysis and probabilistic thinking, considering the odds.
And a profitable decision?
A profitable decision is simply one that yielded gains, regardless of the underlying logic or risk taken. Maybe you bought a lottery ticket and won profitable decision. Terrible process. It's incredibly easy to confuse the two, especially after the fact when hindsight bias kicks in.
And the fear of looking wrong can distort this judgment.
Profoundly. It makes investors reluctant to make a good decision that might not pay off immediately or might even result in a temporary loss because they don't want to look foolish, even if the odds were in their favor.
So how do we pull all of these incredibly rich insights together into a comprehensive toolkit for the thoughtful investor? What's the synthesis?
Marx gives us a powerful synthesis. First and foremost, value remains the absolute foundation. A strong, independently derived sense of intrinsic value provides the conviction you need to buy confidently when the market is in crisis and fear is rampant.
And the discipline to sell.
And the discipline to sell judiciously when euphoria takes over and prices detach from reality. Value is your anchor.
The relationship between price and value is the ultimate key to consistent success.
Buying below intrinsic value, as Marx constantly stresses, is the most dependable route to profit. And it also fundamentally limits your downside risk by building in that margin of safety.
And this relationship is often distorted.
Frequently distorted by powerful forces like mass psychology and technical market factors, creating both immense opportunities for the patient and pitfalls for the impetuous or unaware.
Recognizing cycles and pendulums is vital. Markets and investor psychology are inherently cyclical. They swing back and forth like a pendulum.
And the critical insight here is that most people believe current trends will last forever, either up or down, leading them to make predictably poor decisions at market extremes. They extrapolate linearly.
Contrarianism, the willingness to act opposite to the crowd, is the essential antidote to this dangerous herd behavior.
An appropriate amount of skepticism and a healthy dose of risk aversion are absolutely essential for a rational approach to the market. Resisting excesses, whether they are periods of manic euphoria or paralyzing fear, is a hallmark of truly successful long-term investors.
It's about maintaining your composure when everyone else is losing theirs.
Precisely. And while we can't possibly know precisely where we're going in the future, Marx provides a powerful framework. We can infer where we are in the current cycle by simply taking the market's temperature from others' behavior. When the majority of investors are unworried, complacent, and overconfident, buying aggressively, that's your signal to be cautious and defensive.
And when they're panicked.
Conversely, when they are panicked, distressed, and selling indiscriminately, that's your signal to be aggressive and look for bargains among the wreckage. Use their emotion as your signal.
Crucially, accept that the macro future, the economy, interest rates, geopolitics, is largely unknowable with any consistency.
So instead, focus your energy and analysis on the knowable parts of investing. Things like deep diving into the micro aspects of individual companies, understanding their business models, competitive advantages, management quality, and assessing their intrinsic value.
Seth Klarman and Joel Greenblatt powerfully reinforce this, emphasizing the importance of diligently focusing on what's squarely within your circle of competence and ignoring the rest. don't pretend to know everything.
Marx strongly advocates for defensive investing and rigorous risk control, reiterating Oaktree's core motto: if we avoid the losers, the winners will take care of themselves.
This philosophy involves a heavy emphasis on not doing the wrong thing, building in a substantial margin for error by consistently buying well below intrinsic value.
And strictly eschewing unnecessary leverage, which magnifies both gains and, more importantly, losses. This disciplined, defensive approach is what consistently produces superior asymmetrical result over the long term. More upside capture than downside capture.
It's also fundamentally about maintaining reasonable expectations. You must actively combat unrealistic return goals that can lead to reckless behavior.
Marx uses the infamous Madoff example to show that even seemingly modest but consistently positive returns, with no down months, should be skeptically examined, as they can hint at something too good to be true, like fraud. He emphasizes that there are some returns not worth going for, and certain risks simply not worth taking, regardless of the potential upside.
True investment skill, or alpha, that unique edge we talked about earlier, results in asymmetrical performance.
Meaning capturing significantly more gains than suffering losses, participating more in up markets than down markets, even in environments that are not ideally suited to one's particular style. This type of performance, Marx asserts, comes from unique insight and a disciplined, repeatable process, not just from riding the overall market's movements or beta.
Joel Greenblatt praises Oaktree for its unique practice of actually returning capital to clients when attractive opportunities shrink,
which demonstrates a profound commitment to their disciplined process over simply gathering more assets under management, which is rare in the industry. They prioritize returns for clients over fees from clients.
Finally, Marx empowers you directly with a practical tool: his personal checklist for gauging the risk mood in the market. A way to apply this.
Yeah, he suggests observing key indicators that reveal the collective investor psyche. Things like, is the economy vibrant or sluggish? Is the outlook positive or negative? Are lenders eager or reticent? Are capital markets loose or tight?
More indicators.
Is capital plentiful or scarce? Are terms easy or restrictive? Are interest rates low or high? Are spreads narrow or wide? And crucially, are investors optimistic or pessimistic? Sanguine or distressed? Risk-conscious or complacent? Look at how people are acting.
And his warning based on this market thermometer is stark yet practical. If you find that most of your check marks are in the left-hand column,
meaning the economy is vibrant, outlook positive, lenders eager, capital markets loose, investors optimistic and complacent, the good times column.
As I often do, Marx says, hold on to your wallet. That's when risk is highest, even though it feels lowest.
This provides a tangible, actionable takeaway for you to apply Marx's profound insights directly to your own decision-making, helping you read the room, not just the headlines or the price charts.
What's truly fascinating here is how these seemingly abstract concepts of psychology and cycles translate into practical, real-world awareness.
Allowing you to gauge the market's true temperature simply by observing the underlying behavior of others, and then using that knowledge to act independently, often against the prevailing sentiment.
So what does this all mean for you, the listener? Howard Marks reminds us that investing is not about simple formulas or guaranteed outcomes.
Far from it. It's about a challenging, exciting, and profoundly thought-provoking journey of continuous learning, deep self-awareness, and relentless critical thinking.
It requires understanding both what to do and, crucially, what not to do, especially in the face of powerful human emotions like greed, fear, and the pervasive influence of the crowd.
As you move forward in your own investment journey, armed with these insights, ask yourself, are you truly seeing the market as it is? Or are you seeing it as you wish it to be? Are you chasing returns based on fleeting popularity? Or are you prioritizing the intelligent control of risk by understanding intrinsic value and human psychology?
Howard Marks reminds us that navigating the future requires a deep understanding of probability and outcome, and perhaps most importantly, the quiet courage to act differently from the crowd. How will you use these insights to gain a real edge and become a more thoughtful, more successful investor?
We deeply encourage you to delve further into these powerful ideas, perhaps by reading Marx's book yourself, or by consciously applying this critical thinking to your everyday financial and personal decision-making.
Thank you for joining us on this deep dive.